Look at this.
So we're starting at exactly 9 o'clock.
All right, sir.
Okay, it's 9 o'clock. Good evening, everyone.
Good evening, sir.
Good evening, sir.
It
How was your day, sir?
Good evening, sir.
was fine. And yours?
We thank God, sir. Do very stressful.
Oh, Lagos. I hope you are in Lagos. Lagos
So,
is
I
normal.
mean, the state, our precisely.
Wow. Yeah. Sorry about that. We Lagosians, that one is not strange to us. We know when it comes to stress, it's normal. Part of us. So we should start right away. And tonight we are going to look at Ifrs 15, contracts from revenue from customer. Revenue from contracts from customer. So this standard is very, very crucial. In fact, it's central to almost a very wide range of businesses, because hardly do we have a business that does not ask us to look into how they derive revenue. So for that reason, what actually informs, what are the criteria for you to recognize revenue in your financial statements? So that's the answers this particular standard is how to provide. So I will not take much time. I want us to practically look at the first question and see how our understanding of it. So, but that's why I try to take my time and explain every line, every aspect of this before we move into the question, because it's not even calculation. Nothing is about calculation in the whole two. I'm trying to see if we can look at 2 years together. So it's already shared to you on the group. So, but you need to understand the standard itself very well so that you know how to approach the questions. So let's go into it. In the overview of what IFRS, I think I've shared some other materials with you. If you have the time, that one goes beyond the examination. So if you really want to understand IFRS 15 very well, so I was able to download 2 other sources that are very complex. I don't want to use complex, rather. They are very voluminous. We use that word. Instead of this one that's just 8 pages, there is one I shared that's almost 300 pages. But there's another one like that. So if you have the time, you can go through those reports. This is enough for your exam while I'll try and explain as much as I can. So in the overview, we're made to realize that this was issued in May 2014. And we were called to attention that it replaces a lot of other previous standards and amendments to standards too. IFRIC is like an amendment. They are not real standard. They are just issues that came up that the IASB decide to respond to as regards the standard they will have issued before. So that should be noted. So previously we were made to understand that this standard is how to replace IAS 18 revenue and also IAS 11 construction contracts. In the same vein, interpretation release, those are the things I mentioned the other time. IFRIC, IFRIC 13, that is customer loyalty programs. IFRIC 15, agreement for the construction of real estate, and IFRIC 18, transfers of assets from customers. And lastly, SIC 31, that's revenue, barter transactions involving advertising services. Please, you may need to be able to capture all of these I just listed down in your introduction. I always tell you, when it comes to standard, everything that we make them see you as somebody that understand that standard, that know the standard in total, is what you should put out there for them. So it will actually avail you better mark if you start off with listing all of these. That these are the standard that IFRS 15 came out with. I hope you're on the same page.
Yes, sir.
Hello. Okay.
Yes, sir.
That's why we're on the same page, sir.
Okay. So the basis of issuing IFRS 15 is that they want to merge all of these scattered standards and also piece of bulletin. You can call that bulletin or interpretation. So they want to merge them together to become one. Where only one standard will be able to. That's why that I mentioned the other time that has 300 pages. It's a very voluminous standard actually, based on the fact that it has to match all of this. So that's the basis. So we move on to objective. The objective is to establish principles that an entity shall apply to report useful information to users of financial statements about the nature, amount, timing, and uncertainty of revenue and cash flows arising from a contract with the customer. So that's the objective. It's how to present to users whatever the users will be needing in order for them to ascertain the nature, the amount, the timing, and uncertainty of revenue and cash flow arising from the contract with the customer. So, what are the scope? The new revenue model will apply to all contracts with customers except IFRS 16 leases. You may be able to try and adjust that one somewhere. I think by next week I think I've looked at this before. If I have not, I'll try and see if I can. Have we done this? IFRS 16? The new revenue model will apply to all contracts with customers except IFRS. This is echoing. Have we done leases before in this class?
No, sir. No, sir. We
No,
haven't.
sir.
No,
Okay.
sir, we haven't.
Next week. So, except this is IFRS 16, insurance contract IFRS 17, okay? Financial instruments IFRS 9, we have done IFRS 9 already. Guarantees and setting non-monetary exchanges. So, there is no standard on guarantee actually, but whenever the guarantee occurs, then this standard is not interested in helping us. All of these I mentioned, IFRS 16, 17, 9, and the guarantees, which is not a standard base, they are not covered by these standards. So please, it is very important to IFRS 16, 17, and 9. All of those three standards and guarantees are set in non-monetary exchanges covered.
Sophie, mute your mic. Sophie, mute your mic.
I'm going to my mommy laptop.
Sophia, or what are you now? Sophie,
Sir, please, can you remove the person?
No. I
okay.
Sophia, mute your mic or leave the class.
Mom.
Children that are not even there.
Don't worry, don't worry. So let's move on. So those three standards and anything that has to do with guarantees and setting non-monetary exchanges are not covered. The sale of non-monetary financial assets, such as property, plant and equipment, real estate, or intangible assets, will also be subject to some of the requirements of the new model. So meaning that the last part I mentioned now is not that it's not covered. No, it's covered. That's the point. It's covered. So when you are selling your assets, including PPE, real estate, intangible assets, so it's covered in this new one. A contract with the customer may be partially within the scope of IFRS 15 and partially within the scope of another standard. In which case, please, I want us to be following up with each of the lines. So they are saying here that it's possible that a contract may exist that shared border between IFRS 15 and another standard. So if the other standard specify how to separate and or initially measure one or more parts of the contract, then an entity shall apply those separation and the measurement requirement first. The transaction price is then reduced by the amount that are initially measured under other standards. If other standards do not provide guidance on how to separate and or initially measure one or more parts of the contract, then IFRS 15 will be applied. So it depends. It depends. So that means you need to effectively understand the content of each of the standards. We have like 43 of them. So don't be scared of them. For the purpose of the exam, just try and do past questions based on choose the past question based on how we have already identified the standard that are tested and look out for solutions, go to class, listen, then let's discuss outside the class if there is any other clarification. So the contract, okay. Who is seeing somebody there again?
It's Damilola. Damilola.
Damilola, who are you seeing? He has noted that. So effective dates. Okay, I told us that it was issued in 2014, right? But it became effective on January 1, 2017. So all of that are not my concern like that. So we need to understand each of these types that are defined according to Ifrs 15. Contracts. This is an agreement between two or more parties that creates enforceable rights and obligations. Rights and contracts is an agreement between two or more parties that creates enforceable rights and obligations. Customer. A party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. Income. Increases in economic benefits during the accounting period in the form of inflows or enhancement of assets or decreases of liabilities that result in an increase in equity other than those related to contributions from equity participants. Performance obligation. A promise in a contract with the customer to transfer to the customer either a goods or service or a bundle of goods or services that is distinct. That distinct should be underlined. That is separable. Is separable. You can take it out that this is a unique characteristics that it possesses away from the others. Or be a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. So revenue. Income arising in the course of an entity's ordinary activities. Transaction price. For a contract with a customer, the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amount collected on behalf of third parties. This actually brings to bear the issue of withholding tax. Do you understand? Do you understand?
Please come again, sir.
Okay, I was trying to emphasize when they are trying to divide transaction price, that is an amount of consideration. You know what a consideration is, right?
Yes.
Yes.
Yes, sir.
Okay, so the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amount collected on behalf of third parties. I now wanted to just connect it straight off. That a good example is your withholding tax. You know, the way it's usually done is that when an entity is to pay a vendor, because that vendor is meant to pay tax on the revenue he or she is generating. So government has made it easier that, okay, you that you are paying, you can help government collect its tax and remit it to the government on behalf of your vendor. So for that reason, you will charge your withholding tax on the total amount you are meant to pay. Let's say you want to pay 100 million. You now charge your withholding tax depending on the professionals that are involved or whoever is involved. There are different rates. We have 5%, we have 10%. I think we did those two. Those are the most common ones. So you charge that 10% in addition to the amount you are charging. 100 million plus 10% of 100 million, if it is 10%. If it is 5% of 100 million, that's 5%, that's 5 million. So you add it up, it goes it up. The person will now pay you 105. While you take your whole 100, you render 5 million to the government and you do the tax. That's what they are talking about here. I hope we are clear now.
Yes, sir.
Hello. Wow.
Yes, we are.
Yes, sir.
What's happening now? You are not.
We are with you. We are with you, sir.
Sir, we are following,
We are
sir.
following you, sir. We are listening.
Okay.
We are listening to you,
So
sir.
the revenue model, in fact, this where I am now, this one, whether you want to memorize it, you know, whether you want to, I don't know, or you must know all these 5 steps. Like you must like internalize it. If anything in the exam, if you are able to understand these 5, like And you may not even need to understand. Just be able to write it accordingly. And you need to understand too, because when it comes to explaining it, you need to understand. But you shall need to know them, the 5 of them. Like if they wake you up like this, tell me what are the revenue model. You should be able to just feel it ahead. So I'm calling your attention to it because hardly we didn't want to ask questions on IFRS 15. They have not seen any time they will not refer to this. Any other thing too is also an elaboration for this. So I don't understand. The standard introduces a revenue model in which the core principles is that an entity should recognize revenue to depict the transfer of promised goods or services to the customer in an amount that reflects the consideration to which the entity expects to be entitled in exchange of those goods or services. So there are 5 steps that are involved. 1, identify the contracts with the customer. Before you want to recognize revenue, you must be able to establish that there is a contract between you and the customer. Do you understand? That's the first step.
Yes, sir.
The next step is that having recognized that there is a contract between you and the customer, identify the contract with the customer. You know the topic, the title of the standard is revenue from contract from customer. So identify that there is a contract between you and the customer. So identify the contract from with the customer. You know, I kept saying it. I know what I'm doing because I know how important this is. Okay. Step 2, identify the performance obligations in the contracts. This one, each of them are being broken down, so I don't need to stress myself explaining much now. When we get there, I will explain better. So, having recognized that yes, there is a contract, so then what are the performance obligations? What is required for each of the 2 parties to do? So, identify the performance obligations in the contract. What is required from party A and party B? So 3, determine the transaction price. While you have identified that there's a contract and you have identified the performance obligation of each of the parties, then you can then talk about the determination of the transaction price. At what price is this consideration going to be paid? So the 4th one is when you have already determined the transaction price, then allocate it. Allocation of the transaction price is next. The last one, if all of these 4 have been fulfilled, you can now identify, you can now recognize revenue when the performance obligation is satisfied. Recognize revenue when the performance obligation is satisfied. If the performance obligation has not been satisfied, you don't recognize revenue. A good example is you want to build house as a contractor. You have been paid upfront. Maybe the total cost of building a house is 3 billion. You have been paid 3 billion already as at 1st January 2025. But you have not started building the house. In the plan drawn up by the architect, each of the levels is tied to a particular amount in that 3 billion. So if you have not been able to deliver any part of it corresponding to an amount identified in your contract, then you don't recognize the revenue. Does anybody understand what I've said?
Yes, sir. We do.
Yes.
Or a very simple one. This may be, yes, this is that one. The one I just cited is very necessary, but it's very simple one that is straightforward that I hope everybody will be like. You want to buy food, and part of the requirement from the company is that you pay before it's delivered. I'm just citing an example. For whatever reason, let's say you pay today, but the phone will be delivered to you next week. That company it is wrong for them to recognize the revenue today. You know why? They have not delivered their own, they have not performed their own obligation You understand? They can't recognize revenue until they have performed the obligation required from them. So that's the simple one I think I can come up with. Like, you have received money, yes, but you have not done your part. You have not delivered on your own promise, on your obligation. Then you don't recognize revenue until you have been able to do that. So I hope you understand, please.
Yes, sir.
Yes,
I
Any
understand.
question?
No question.
Okay, let's move on. So that step one now is now being broadly. I hope you can see my screen.
Yes,
very
sir.
well,
Yes, sir.
sir.
Yes, sir.
We can.
Very clear.
Okay. So it's now broadly discussed now, so which will make it more understood. A contract can be owned, written, or implied by an entity's business practice. This should be understood. You can come into a contract with a oral exchange of information. It can be written, could be implied by an entity's business practice. That is what they do on the norm. What they do on the norm. So there is no written rules, there's no make pronouncement about it, but what they do on the norm actually put them in the way of entering a contract with people. So a contract with a customer will fall within the scope of IFRS 15 when all the following criteria are met. This is just identification of contract. You see how the other four distinctly explained. One, the parties to the contract have approved the contract. Please, all of this step, maybe you need to, because I will not come back here and you will answer the 2024 question. If you understand all these steps, you answer them correctly. If you don't understand it, you answer it either wrong. Now, these are the 5 steps or 5 areas you need to confirm before you confirm that yes, there is a contract with the customer. One, the parties to the contract have approved the contract. You know, it's possible there is a contract done up, and we are still waiting for the CEO of the other company to sign. If the signation has not been appended, then contract is not in existence. Each party's rights in relation to the goods or services to the transfer can be identified. Yes, the case I just mentioned now. You are meant to deliver a particular product. You have not delivered it. Then the right of the other party has not been fulfilled. But we don't even know what A is collecting from B. And we are saying that we are in a contract. Which contract is that? This one I mentioned now, you want to buy phone. And the other party is collecting money for you buying phone. That's the consideration they are receiving. For that reason, there is a contract. There are rights that each of the 2 parties are meant to exchange or receive. Are we on the same page?
Yes, sir.
Yes, we are
Okay, so
on the same page.
terms and conditions for the goods or services.
Yes, sir.
The payment terms and conditions for the goods or services to be transferred can be identified. Yes, we know. I just mentioned it now. Okay, this one has even been. Okay, let me look at another one. That's okay. The one of the building I mentioned earlier, or let me say you want to buy a car, but you don't have the full amount now. You want to pay instrumentally, and you have defined that you'll be paying in every quarter, 3 months. So if that is the contract you enter into with the dealer of the car, of the vehicle, there's no problem. You have been able to state how the payment terms are and the condition attached to it. Probably if you have paid the whole sum immediately, you are going to pay lesser than if you actually elongate these payments. Say maybe they will have 10%, 20%, 5%, depending. Those are the things we are talking about. The payment terms and conditions for the goods or services to transfer can be identified. The contract has commercial substance. It's not for free. Yes, it's not profit making. No. There is a commercial intent between the two parties. The last one is the collection of an amount of consideration to which the entity is entitled to in exchange for the goods or services is probable. Yes, you can easily confirm that yes, there is a consideration to be received by the parties involved. If the above criteria are met, a contract shall not be reassessed unless there is an indication of a significant change in facts or circumstances. However, if the contract does not meet the above criteria, the entity will continue to reassess the contract going forward to determine whether the criteria are subsequently met. So, hope no question at this point. We are moving forward.
No questions, sir.
Hello, are we still together?
Yes, sir.
Yes, we
We
are
are
together.
together.
Yes, sir, we are
Okay.
together.
Listen to this too and pay attention to it. The model is to be applied on an individual contract basis. Meaning you don't sum everything up, say yes, this one, they are contracts. No. You need to identify each of the contract on its own merits, analyze it properly. However, as a practical experience, a portfolio approach is permitted for contracts with similar characteristics, provided it is reasonably expected that the impact on the financial statement will not be materially different from applying this model to the individual contracts. This is very, very crucial. If there are similar contracts that the content of the contract are the same thing, then you can go ahead and group them together and give them the same treatment. This so further will not lead to any material difference in the financial statement. The contract modification shall be accounted for as a separate contract if the following conditions are met. Just two of them. There is an addition of promised goods or services that are distinct and which increases the scope of the contract. And so who can explain what they mean by this first point? What do you understand by that? Let me see whether we are on the same page. Hello, is anybody there?
Hello?
Yes, sir.
Yes,
We are
now.
here, sir.
I was asking the question. What do you understand by this first point?
Yes, assuming the terms has been modified from the previous one. You understand? It should be written for both parties to agree on.
No. See, they said the contract modification shall be accounted for as a separate contract if the following conditions are met. The first condition now, there is an addition of promised goods or services that are distinct and which increases the scope of the contract. So what do you understand by that?
Okay, sir. Good evening, sir. I feel
Good evening.
that means that every contract has its own unique purpose, and a modified contract means like a different goods can make the contract go in another line. So because of that, they need to have a separate contract signed for that particular additional transaction, because that might not be in line with the previous ones that they have on ground.
Definitely, thank you. So whenever you realize that the content of the contract has changed considerably, significantly, then you need to assume a new contract is coming up away from what you have before. Secondly, the price of the goods of the contract increases by an amount of consideration that reflects the entity's standalone selling prices of the additional goods or services, and any appropriate adjustment to that price to reflect the circumstances of the particular contract. So when the price changes too, and it's to create an additional amount expected from the client or received by the seller as well, then we know that there is a modification to the contract and it should be accounted for separately. Are we okay? I'm moving on now.
Yes, we are.
Yes, sir. Yes, sir. Move on.
If the above conditions are not met, a contract modification will be accounted for prospectively or retrospectively. When they say prospectively, that is, it will not affect historical financial records. It only affects the current period and the subsequent ones. That's prospectively. When it is retrospective, that will affect the previous years, previous period. So we move to step 2. Identify the performance obligations in the contracts. How do you do that? At contract inception, an entity shall assess the goods or services that have been promised to the customer, you can see, and shall identify as a performance obligation a goods or a service or a bundle of goods or services that is distinct. A series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. So you need to identify what is the performance obligation, what is the company required to deliver to the customer. So the criteria for identifying whether a goods or service is distinct, there are just 2. The customer can benefit from the goods or service on its own or together with other readily available resources. The entity's promise to transfer the goods or services to the customer is separately identifiable from other promises in the contract. So that's what verifies the identification of performance obligation in the contract. A series of distinct goods or services has the same pattern of transfer to the customer if the following criteria are met. Each distinct goods or services that the entity promises to transfer consecutively to the customer will be a performance obligation that is satisfied over time, and the same method of measuring progress will be used to measure the entity's progress towards the complete satisfaction of the performance obligation to transfer each distinct goods or services in the series to the customer. So this is talking about when we have a series of distinct goods that have the same pattern, then this approach to treat it. Factors for consideration as to whether an entity's promise to transfer the goods or service to the customer is separately identifiable include, but are not limited to: the entity does not provide a single service of integrating the goods or services with other goods or services promised in the contract. The goods or service does not significantly modify a customer or another goods or service promised in the contract. The goods or service is not highly dependent on or highly interrelated with other goods or services promised in the contract. So there is an example here to illustrate whether goods or services, whether we can see it as being distinct or not. An entity, a software developer, enters into a contract with the customer to transfer the following: software license, installation service includes changing the web screen for each user, software updates, and technical support for 2 years. The entity sells the above separately. You can see the installation service is routinely performed by other entities and does not significantly modify the software. Software remains functional without the updates and technical support. Are the goods or services promised to the customer distinct in terms of availability? The software is delivered before other goods or services and remains functional without the updates and the technical support. Therefore, the entity concludes that the customer can benefit from each of the goods and services either on their own or together with the other goods and services that are readily available. The promise to transfer each goods and services to the customer is separately identifiable information that we can see it from the question. In particular, the installation service does not significantly modify or customize the software itself, and as such, the software and the installation service are separate outputs. They are trying to see the practical way of separating. So, separating distinct, to identify a distinct products or goods or services. So, at the end of the day, you can conclude that 4 performance obligations have been identified: software delivery, installation service, software updates, and technical support. So, they are distinct requirements or obligations. Step 3, determine the transaction price. Transaction price will be the amount of consideration that an entity expects to be entitled to in exchange for transferring promised goods or services to a customer. You need to determine what the transaction price is. An entity will consider the terms of a contract and past customary business practices when making this determination. How? What are the basis of determining the transaction price? If a contract contains a variable amount, the entity will estimate the amount to which it will be entitled under the contract. The consideration can also vary if an entity's right to consideration is contingent on the occurrence of a future date. The variable consideration is only included in the transaction price to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty associated with the variable consideration is subsequently resolved. So, there's a question here that I need us to look at together and see whether we get it right. Big Bed enters in a contract with a customer to sell beds for $400 per bed on 1 January 2017. If the customer purchases more than 1,000 beds in a calendar year, the contract states that the price that the price per unit is retrospectively reduced to $380 from $400 per unit. As a result of this, the consideration in the contract is variable. That means it applied to the number of quantity purchased before it can be applied. As on March 2017, Big Bed sells 80 beds to the customer. Therefore, Big Bed estimate that the customer's purchase will not exceed the 1,000 bed threshold required for the following discount in the calendar year. Now, let's move into it. When considering the requirement of IFRS 15, in particular paragraphs 56 to 58, and the significant experience Big Bed has with this product and the entities purchasing pattern, it was concluded that it is highly probable that a significant reversal in the cumulative amount of revenue recognized will not occur when the uncertainty is resolved. That's when the total amount of purchases is known. Consequently, the entity recognizes revenue of 32,000, that is 80 beds multiplied by 400 for the first quarter ended 31 March 2017. Why did they still go ahead and recognize 80 naira? I mean, 400 naira. is because the limit set has not been reached. We are looking for 1,000. So 1,000 was not achieved. So we move on. At the beginning of June 2017, the customer requires another company, and at the end of the second quarter, 30th June 2017, Big Bet sells an additional 500 beds to the customer. In light of the new fact, Big Bet estimates that the customer's purchase will exceed the 1,000 bed threshold. For the calendar year, and therefore it will have to retrospectively reduce the price per unit. So what this is saying is, going by what the customer has purchased from the beginning of the year to date, it shows that they are likely going to meet the threshold of 1,000 as at the rate they are going. So as a result of that, they need to treat it retrospectively. That is, the 400 they have been recognizing has to be reduced, and 380 is to be charged. They have not gotten to the point where they have confirmed that the client has met up with 1,000, but from historical data, what they have bought till that time, when the period has been considered there, is likely to take them to 1,000. So allocate the transaction price. We have been able to determine the transaction price. How do we allocate? An entity shall allocate the transaction price to each performance obligation in an amount that depicts the amount of consideration to which the entity expects to be entitled in exchange for transferring the promised goods or services to the customer. Where a contract has many performance obligations, an entity shall allocate the transaction price to the performance obligations in the contract by reference to their relative standalone selling prices. If a standalone selling price is not directly observable, an entity will need to estimate it. So, how to do that? IFRS 15 provides some guidance. Adjusted market assessment approach, expected cost plus a margin approach, residual approach only permissible in limited circumstances. So sometimes the transaction price may include a discount. Any overall discount is allocated between the performance obligation on a relative standalone selling price basis. In some circumstances, it may be appropriate to allocate the discount to some, but not all of the performance obligations. So this is just talking about how to treat the discounts. So let's look at this example. A fashion outlet named Fashionable regularly sells scarves, shoes, and handbags individually, thereby establishing standalone selling prices as illustrated below. So we have scarf, $40, shoes, $55, handbag, $45. Total is 140. So in addition, Fashionable regularly sells shoes and handbags together for 16 naira. So this one is not separable. Fashionable enter into a contract with the customer to sell all three products in exchange for $100. Fashionable will satisfy the performance obligation for each of the products at different points in time. Because that includes a discount of $40 on this overall transaction, this discount will be allocated proportionally to all the obligations So this discount will be allocated proportionately. Okay, sorry. Fashionable enter into a contract with customer to sell all three products in exchange for $100. That is, the amount that is supposed to sell it is 140. But when the three are to be bought together, then it has decided to sell it for $100. The contract includes a discount of $40, yes, on the overall transaction. This discount will be allocated proportionately to all three obligations when allocating the transaction price using the relative standalone selling price method. However, because Fashionable regularly sells shoes and handbags together for $60 and it's car for $40, it has evidence that the entire discount should be allocated to the premises to transfer shoes and handbags in accordance with paragraph 82 of Ifrs 15. If Fashionable transfers control of the shoes and handbags at the same point in time, then Fashionable could, as a practical matter, account for the transfer of those products as a single performance obligation. That is, the entity could allocate $60 of the transaction price to the single obligation and recognize revenue of $60 when shoes and handbags are simultaneously transferred to the customer. If the contract requires Fashionable to transfer the control of the shoes and handbags at different points in time, then the amount of $60 is individually allocated to the products based on their standalone. So this is the way they now did the calculation. We have for shoes and handbags now. One they used to sell for $60 rather. So one is 55, the other one is 45. Then you divide it by $100, which is the amount they will collect for the three of them. So multiply by the $60 that we have identified that this one will worth. The same thing for handbag. So we get $60. After all of this has been confirmed, then recognize revenue. An entity shall recognize revenue when or as it satisfies a performance obligation by transferring a promised goods or service to a customer, which is when control is passed either over time or at a point in time. So there are two things here. One, certification of performance obligation. Two, passing of control. An entity recognizes revenue over time if one of the following criteria are met. One, the customer simultaneously received and consumed the benefits provided by the entity as the entity performs. The entity performance creates or enhances an asset that the customer controls as the asset is created or enhanced. The last part, the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for the performance completed to date. Yes, I mentioned this before. For a performance obligation satisfied over time, that is spread beyond the current. For a performance obligation satisfied over time, an entity will select an appropriate measure of progress to determine how much revenue should be recognized as the performance obligation is satisfied. So what are the factors that indicate that yes, control has been passed from the owner to the the current owner as well? One, the entity has a present right to payment for the assets. Two, the customer has legal title to the assets. Three, the entity has transferred physical possession of the assets. Four, the customer has significant risks and rewards related to the ownership of assets, and the customer has accepted the assets. So those are the 5 criteria, 5 factors you need to hand over, hand on. To contract cost now, you have incremental cost of obtaining a contract. I'm trying to see what the content of this. Okay, so I'm just going to discuss briefly on this. Then we can see if we can solve our questions. So I hope we are warming up for the questions. Because of time, I don't think I want to.
Yes, sir.
we are warming up.
Okay, so is the entity expected to recover incremental cost of obtaining a contract with the customer? The entity shall recognize those costs as an asset. It will just be like you are amortizing. So, like what happens under research and development, you can amortize your expenses. You don't expend them, you amortize it. It will be like you are doing depreciation or PPE. So, the incremental costs are those costs that an entity incurs to obtain a contract that it would not have been incurred if the contract had not been successfully obtained. For example, a sales commission. A practical expedient, however, exists following allowing the incremental cost of obtaining a contract to be expensed if the amortization period will be 1 year or less. Yes. So this is an example of the consulting services entity wins a competition bid to provide consulting services to a new customer. The following costs were incurred by the entity to obtain the contract: external fees, travel costs, commission, total costs. In accordance with IFRS 15 paragraph 91, the entity recognizes an asset for the $10,000 commission incremental cost for obtaining the contract because the entity expects to recover those costs through future fees for consulting services. The entity also pays discretionary annual bonuses to sales employees based on annual sales target, overall profitability, and individual performance. Taking into consideration IFRS 15, the legal fees and travel costs will have been incurred whether the bid was won or not. Therefore, those costs are recognized as expenses when incurred, unless they are within the scope of another standard, in which case relevant provisions of that standard apply. So here, they are trying to explain what incremental cost is all about and what does it entail. It entails that incidental costs, yes, it's tied to an incident, connected to an incident. So for that reason, if those incidents do not occur, then there's no incremental costs. But if they do occur, that means there is incremental cost in that regard. So So, under presentation, an entity shall present the performance of a contract in the statement of financial position as a contract assets or contract liability, depending on the relationship between the entity's performance and the customer's payments. Any unconditional rights to consideration shall be presented separately as a receivable. So I think at this point, I want to go to the question. Have we all opened the question now? If you have not done that, please do. Hello, are we there?
Yes, sir.
Yes, sir.
Yeah, yes, sir. We are with you.
Very good.
So please open the question. Are we ready?
Yes, we are, sir.
So, we are the chief accountant of
ready.
PLC that prepares consolidated financial statements. The managing director, who is not an accountant, has recently attended a workshop at which key corporate reporting issues were discussed. The management director remembers being taught the following at the workshop. This is one of the approach I can use to distract you. If I were you, I would rather concentrate on the conditions we have learned this night. Are they present? Are they available? So, what are the things the managing director actually learns? That financial statement of an entity should reflect the substance of its transaction, not form. Substance over form is one of the principles or concepts. So the first one is that financial statement of an entity should reflect the substance of the transaction. It should not be form, it's substance. Revenue from the contract with customers should only be recognized when certain conditions have been satisfied. Yes. Transfer of legal title of the goods is not necessarily sufficient for an entity to recognize revenue from their sales. So the financial year end of JAPA PLC is August 31. In the year to August 31, 2021, the company entered into the following transactions. Transaction 1. On March 1, 2021, JAPA PLC sold a property to Kalu Bank Limited for 50 million. The market value of the property at the date of the sales was 100 million. However, JAPA PLC continues to occupy the property rent-free. JAPA PLC has the option to buy the property back from Kalu at the end of every month, and from March 31, 2021 until February 28, 2026. JAPA PLC has not yet exercised this option. The repurchase price will be 50 million plus 500,000 for every complete month. The repurchase price will be 50 million plus 500,000 for every complete month that has elapsed from the date of sale to the date of the purchase. Kalu Bank Limited did not require JAPA PLC to repurchase the property, and the facility will lapse after February 28, 2026. The director of JAPA PLC expects property price to rise at around 5% each year for the foreseeable future. So this is the first case. on re-adopting Ifrs 15. Like I mentioned, we need to analyze it under the lens of defined criteria costs. So from this, can we determine whether there has been a contract? And we are going to break it down as we did in the when I was explaining it. So firstly, identify the contract with the customer. That's the first step. Can we identify the contract with the customer in this case? Hello, anybody
Yes,
there?
yes, we are here, sir.
Who is going to full lead, or I should start calling your name? You know, this is a practical question, so do well to don't go and copy, don't go and be checking the answer. Just apply what you are playing tonight. Let's see whether you understand. Oh yeah, anybody?
There was no
If you are not
contract.
talking,
There was no any contract between them at the beginning.
Why?
Because Japa was still occupying the right and has not exercised his own option.
Okay, so you really tried. I need another person. Well done. I will make a comment later. But well done, you've tried. Another person.
Just going by this scenario, I don't think there is any contract. Japa is
Why?
all because Japa is all the property to Kaluka meters. So in this case, I don't think is there any contract going by the case scenario.
Okay, another person. Well done, thank you.
Let me try, sir.
Where are you going?
I will still go with the previous speakers because here they said they have the option, not an obligation, to exercise the right of buying back the property. So I don't think it's a contract.
Okay, you guys have tried. I love that. So, first thing is that what are the criteria for contract to hold? Those 5 things, those are the things. If you want to answer them, I told you guys, you start with, you first state your facts before you now go into the case study they have given you. Go into the question to now apply that, the identify points, the principle, the criteria. You now apply it to it. Are you getting me at all? So you first state all of those 5 things that make up, that confirm whether something is a contract or not. And we have done it tonight. And I was emphasizing it. So you look at those 5 criteria or 5 points. Let me just remind you about them. The parties to the contract have approved the contract. In fact, if you use this method, it will be easier for you to nullify or confirm whether it's a contract or not. The parties to the contract have approved the contract. I will not do like you. I will first list. I want to read all of them again. 2, each party's rights in relation to the goods or services to be transferred can be identified. 3, the payment terms and conditions for the goods or services to be transferred can be identified. 4, the contract has commercial substance. The last one, the collection of an amount of consideration to which the entity is entitled to the necessary for the goods or services is probable. Now, you now start. The parties to the contract has approved the contract. Where?
Did they approve the contract?
Yes.
So, hello.
Yes, there's an agreement between them.
Okay, good. Which parties' rights in relation to the goods or services to be transferred can be identified? Do we have their rights being spelled out?
Yes.
Do we agree with him or her? I don't know. I'm not getting.
Yes,
Yeah,
sir.
the contractors have agreed to transfer the property to Kano.
No, they said each party's rights in relation to the goods or services to be transferred can be identified. Right of each of them. Oh yeah. Can we identify their rights separately?
Yes, sir.
In relation to the goods or
Yes, sir.
services to be transferred?
Japa is to transfer the property to Kano.
Okay. But when we get back here, yes, we were told that look at this. The second paragraph. The repurchase price will be 50 million plus 500,000 for every complete month that has lapsed from the date of the sales to the date of the purchase. Allocating Bank Limited did not require Japa PLC to purchase the property, and the facility will lapse after February 28, 2026. What does that imply?
Sir, if I'm with you, looking by the question or the scenario, in the initial stage, the question is no independent contract. But going the process, on the process, the thing will be when the thing is continue, it will become a contract. So my question is that I can ask a question, sir.
Go on.
My question is that if this thing is happen in the initial step, the thing is not a contract; it's a normal business between party A and party B. But when the thing is continue, now it became a contract. So if this thing is happen, can I use the scenario as a after looking all the steps, can I identify all the things? For instance, the price of the contract, the determination of the price, all I can use it as a contract. That's my questions. Are you getting me?
Sorry, I didn't get that question. Can you increase the pitch of your voice a bit?
What I'm saying is that in the initial step, this scenario becomes contract but one thing is going on to become a contract.
When did it become a contract, Abi?
Looking by the scenario, they say the Japa purchase. You understand? This the paragraph whereby the Japa is reported.
Kano did not expect Japa to repurchase the property from him, if I'm correct.
Okay.
Yes, that was stated. You know, this is one of the best way I can love to ask questions. They will confuse you.
But excuse me, according to that question, Japa did not hand over that property to Kano.
Exactly. There is no
Japa was
control.
still
Did you not
occupying
mention
the
control
property.
when we were discussing? Did you not mention control when we are
Mentioned
discussing?
it. Yes.
Yes, now. There is no control. When control is not in place, then there is no contract.
Said in your explanation at the EL of this section that once the company is not hand over, the property or service has not.
There is no control.
No contract.
Another point that you can use, that number 4, the contract has commercial substance. This is not a commercial substance. How? Somebody wants to buy something from you, and is already telling you that, see, I'm not going to pay the market price. What does that imply? It's not a discount. If it's a discount, they will have stated it. Somebody, the price of something is 100 million, The person
Yes,
is paying 50 million. That makes it not a commercial substance again now.
There have not been any consideration between them.
That makes
And it's
it
not
not
related
commercial.
party either.
Yes. Please don't make mistake. I understand this very well. I will not be surprised if they decide to bring it out this coming diet. Just
So,
saying.
sir, what is the final answer now, please, sir?
No, the answer is elaborate. Firstly, you list all the five items here, all the 5 points under contracts, identify the contract with the customer. You list all each of them. You now start explaining them according to this contract, this particular question, the content of this question. That's fine. The parties to the contract have approved the contract. Yes, they approve it. But even that approval is dependent on, is not conclusive. Why? Because they said that the JAPA has not decided, has not concluded to, they are still going to buy back. It's not a direct, there's an option for them to buy it back. If they are actually selling, you can't sell something and still buy it back. Are we together?
Yes, sir.
Yes, sir.
Sir, sorry for the interruption, sir. Are you saying that this 6 points, is it 1, 2, 3,
five?
And
Five
no,
points.
JAPA is still
The
occupying the property.
Excuse me. Are you saying, sir, the 5 points at the beginning of the contract, let's say 2 of it, as we are reading the question, is being considered, but at the end, at the middle, 1 is being broken. So in that case, there is no any contract. The 5 must be
all
completed.
of them must be in place. All of them.
If 1 is missing, the contract is no more there. Is that?
Yes, if 1 is missing, no, for reason that just one is missing. There is no contract.
So the 5 must be exercised. Thank you, sir.
Yes.
Thank you.
Then it means that the 5 must be binding before it can be considered.
That's what the contract is all about.
Exactly.
Remember, I even told you that. I mentioned that the contract must be binding on the 2 of them. But this case, the contract is not even binding. The way it's stated, they said they can decide to buy it back. That means it's not a binding contract now. It's not a binding contract. There are so many loopholes that you can identify. So you mention all these 5, you now treat it, you explain it based on the question to confirm whether it's actually a contract or not. Before you now move, if it's not a contract, don't bother moving to the next thing. Consideration, forget that one. What's it called? Performance obligation to be identified. Don't go to that level. The first thing is to identify whether it's a contract or not. If it's a contract, then we can now move on to identification of performance obligation. Then determine the transaction price, allocate the transaction price, then recognize the revenue. Yes, this is May 2024. I think this question 6, if I'm not mistaken. Are we together? So let's check out the second one. There are two transactions there. On September 1, 2020, JAPA PFC sold one of its branches to Andrew Tourist Nigeria Limited for 80 million. Listen very well for this one. The net asset of the branch in the financial statement of JAPA PFC immediately before the sale were 70 million. Before I move further, what does this imply? What's the relationship between JAPA and Andrew Tourist Nigeria Limited?
Come again, sir, please.
On September 1, 2020, Japa PLC sold one of its branches to Andrew Tourist Nigeria Limited for 80 million. The net asset of the branch in the financial statement of Japa PLC immediately before the sale were 70 million. You said?
It was sold at a premium.
Andrew and Japa, they have become what now?
Parents and subsidiary.
There's a,
Associates.
there's a contract between them.
Group account.
There's no contract. There's no contract to get it right. On September 1, 2020, Japa PLC sold one of its branches to Andrew Tourist Nigeria Limited for 80 million. The net assets of the branch in the financial statements of Japa PLC immediately before the sale were 70 million. What's the relationship between Japa PLC and Andrew Tourist Nigeria Limited?
Parents of
there is no relationship with that. There's no
relationship, sir.
I just want to confuse
No
you.
relationship.
The deliberate attempt to confuse you. There's no relationship between them. Japa is the seller. Andrew is the buyer. It's as simple as that. The relationship that is to exist between them is the one of contracts, seller and buyer. Is that not?
Yes, sir. Buyer and seller.
No, I don't want to confuse you. Just throw up that question to see whether you get confused. Sorry. Andrew Tourist Nigeria Limited is a subsidiary of Kalu Bank Limited and was specifically incorporated to carry out the purchase. You need to start paying attention better now. Let me read that again. Andrew Tourist Nigeria Limited is a subsidiary of Kalu Bank Limited and was specifically incorporated to carry out the purchase. It has no other business operations. Andrew Tourist Nigeria Limited received the 80 million to finance this project from its parents, Kalu, in the form of a loan. Japa PLC continues to control the operations of the branch and receives an annual operating fee from Andrew Tourist Nigeria Limited. The annual fee is the operating profit of the branch for the 12 months to the previous August 31, less the interest payable on the loan taken out by Andrew Tourist Nigeria Limited for the 12 months to previous August 31. If this amount is negative, then Japa PLC must pay the negative amount to Andrew Tourist Nigeria Limited. Any payment to or by Japa PLC must be made by September 30 following the end of the relevant period. In the year to August 31, 2021, the branch made an operating profit of 20 million. Interest payable by Andrew Tourist Nigeria on the loan for this period was 8 million. Oh yeah. Before I go further on this transaction too, let me examine the question. In accordance with Ifrs 15, revenue from contract with customer discuss the conditions that need to be satisfied before revenue can be recognized. I'm going to call you one by one by myself. Don't talk here too. Omotola, give us the first one. According you, if I call you, know the one they are mentioned.
Number one, you have to identify the contract between. You have to identify there's a contract between them.
Okay, identify the contract with the customer.
Yes.
So can you further elaborate a bit on that? What are the things we need to look into to confirm that there is a contract? Don't worry. You can read it up later, but notes when you are discussing that part. You first list all the 5. Then those ones that need further analysis or breakdown, you discuss it accordingly too. So that you get your full mark. Okay. Esther. Is Esther with us? Umog.
Yes, sir, but it's confusing.
And that's why I'm asking you, so that it will not be confusing again. What is confusing there?
I don't even know how to put it.
Put it anyhow, we understand the word. You are very good at understanding. Oh yeah, we don't have all the time. Okay, Umog.
Identify separate performance obligations.
You said?
Identify separate performance obligations.
God bless you. So that's number 2. So can you further explain that? Can read it up. Lots of time. Umog, grab you. Said? We are not speaking up. Oh. Can't hear you.
I say I can't see.
You said?
May I list the remaining part?
The third condition. The third condition.
The third condition is determine
Okay.
the price of the contract.
Determine the transaction price. Determine the transaction price. Determine the transaction price. Okay, next.
Allocate the transaction
Allocate
price.
the transaction price. Recognize revenue when a performance
No,
obligation.
Allocate the transaction price.
Revenue will be satisfied.
Allocate the
Recognize
transaction
when
price to
the
what?
revenue when
To the
recognize
performance
when
obligation.
To the performance obligation.
Yes. Okay. Don't miss out this kind of thing. No. Just beg you. Okay, so that's if you are able to do all of this, like I told you, you need to still break them down. You know, I cannot give you free mark. You just write all these 5 alone. You can't get that 5 marks. So I can bet it with you. You can check how the mark is in the background anyway. You will confirm whether I'm lying or so you need to still tell them some other things, like break each of them down ahead. That's when they know you are ready for their mark. What we have been doing before now is what they now want us to do in B. And that is 10 marks, 5 marks for each of them. To get that 5 marks, you go a long way. So you first list whether it's a contract, because that's the first thing. So that second one now, you can see for yourself that one is even worse than the first case. This second case is worse. This second case is what? Is worse. In fact, this one is clearly no contract at all. Why? Firstly, there is related parties transactions here. You know, the company that actually helped Andrew to go on with this purchase is one of the subsidiary of Kalu. And they stood in as their agent. That is totally wrong. Contract-wise, it's totally wrong. It should have been a neutral party. Secondly, we can say that this passed for a commercial transaction actually. You know, the amount, what we call the
net assets was 70 million and it was sold for 80 million. That one is fair. That's better. So then, yes, go on.
So are you saying the contract should not be at arm's length?
It should be.
It should be
maybe
at
that was
arm's
why
length.
we faulted the other one.
Okay.
It should be at arm's length.
At arm's length. Okay.
That's why we faulted the first one. Now this one was at arm's length. You know, there was a caveat they put that Andrew Tourist Limited received the 80 million to finance this project from its parent company. That one does not concern us. It's between Andrew and his parent company, so that you don't get caught up in unnecessary details. This one does not concern the seller. Where he sees the money from. Nothing concern me. We just get money and he has bought. Nothing concern where he sees the money from. But to go further, they now said that I'm listening. This is where there is fire on the mountain. They said Japa PLC continues to control the operations of the branch and receives an annual operating fee from Andrew Tourist Nigeria Limited. Before we even go further, is this a contract? Based on your knowledge, your understanding so far, is this a contract at this point?
It's not, sir.
It's not more like a source.
Why?
Collecting annual operating profit is not a price of a contract.
So revenue is not occurring here. There is no contract. You can't be talking of revenue.
More like is this something like more like an investment option?
Because the DAPA still control the.
Yes, once the control has not passed, then there is no contract.
No contract.
There is no contract. It's just like you are involved in this. You know, they said the annual fee is the operating profit for the brand for 12.2, and they are also going to be paying from their profit. All of those things, no, doesn't make sense. So all of these points are the things you need to bring to the fore for you to adequately get your mark correctly. Are we okay? I want to move to another question.
2 bits, sir.
Can you see another one? This is May 2023 now. Is that what you are seeing?
Hello, sir.
Okay, I think you are still seeing. Let me see. What are you seeing? Is it May 2023 you are seeing, or is it question 4 you are seeing, or question 7 or them?
Question 4, sir.
Yes, it is what we are seeing.
Hello, sir. Can you hear me?
Yes, I can hear you.
Okay. Please, I have a question.
Go on.
Okay. So, I noticed that one of the in both question we have looked at, one of the criteria we are using to note that it's not a contract or doesn't fulfill the contract requirement is the purchase price against the fair value. For example, the last one we looked at now, the property was, can you quickly scroll back to that part?
It's the one that has 70 and 80 million.
Yeah, okay. So yes, that one now. So it was the property is what this one. So it was sold for 80 when the value is actually 70. So you said this is fine. Unlike the other one that was the opposite. So my question now is, what if is a case of where the buyer is a good bargainer which leads to something like gain on bargain purchase, or we just have to automatically disallow it, not allow it once what the person is paying is less than the value of what the person is buying. I don't know if you understand my question.
I didn't get the question very well.
Okay.
I got your explanation up to the point where you said, I think you are not speaking up, or is he speaker from your head or something?
Okay, is it better now?
Yes, yes.
Okay, so I just noted that in the two examples we looked at, one of the criteria we are using to ascertain if the contract exists, one of the criteria, not because there are other criteria, but one is the amount paid against the worth of what the person is buying or what the entity is buying. Can you hear me?
So you are saying that one of the criteria is the amount the item is exchanged, Abi?
Yeah, I'm following your thoughts because in the first example, there was a high level of more like negative goodwill, kind of gain on bargain purchase. And you said, no, that cannot be. I have something worth maybe 50 naira, you are paying me 30 naira for it.
Yes. Okay, I understand now. So what really happened there is that, aside the fact that, yes, I will still go back to that, but aside the fact that the price is less than the fair value, let me use that word, it's not a sale, a revenue based contract. The reason is that there is a clause in that agreement that actually exposed to us that the company that is selling has the intention of buying back. So you can't buy back in revenue contracts. Buyback is another thing entirely. It's not a contract of sales or revenue. So that's maybe, in fact, that's what actually said they sold it out, that no, this one is. But the fact that you are buying something at a less than the face value, no, it also not. That means the consideration is not commensurate to, and we learned from our one of the principles that yes, the consideration must be equal to what is exchanged.
Okay.
You understand?
Yes, sir. Thank you.
Okay, let's move on now. You will finish today's class by 11. Okay, so the question goes thus. There has been significant divergence in practice over recognition of revenue, mainly because international financial reporting standards contain limited guidance in certain areas. The International Accounting Standards Board, ISB, as a result of the joint project with the US Financial Accounting Standards Board, FASB, has issued IFRS 15, revenue from contracts with customers. IFRS 15 set out a 5-step model which applies to revenue earned from a contract with a customer with limited exemptions, regardless of the type of revenue transaction. Okay, discuss the criteria which must be met for a contract with a customer to fall within the scope of IFRS 15. This one is a bonus. This question is a bonus. I'm not sure they will repeat this kind of question again. I can. It's a bonus. The reason I say it's a bonus is that they allocated 10 marks. It's the same question they still has in that 2024 that they put 5 marks to. Okay. So this one is a bonus. So it's like just want to give you mark like for free. Olaide, yeah.
Yes, I want to ask. You said discuss the criteria which must be met. Now we have 5 points. That means beyond listing those points, I will have to discuss some other things. We have to give like all them, like the information you give onto the or what like contract has capital, like that 5 points on that.
If the mark is even as low as small as 5 marks, you should go beyond just listing. I said it before when I was treating that 2024 question.
insofar you though you need to manage your time too, but if you go beyond just this, because the minimum everybody will do is to list. And how do you now get better mark? If you check the Pathfinder, check the answer, go to the examiner's report, see how they allocate marks. They usually tell you how they allocate the marks. You see. So that 5 marks, this one that is now 10 marks, automatically you need to go beyond just listing. Automatically, you will explain self. You will explain each of like that contract, identifying the contract now that has 5 points. You need to list all those 5. You need to explain it. So determine the performance obligation. You need to explain what you mean by that. And all of those ones are the things that is contained in the material I already shared with you. And I even gave you some other materials too. So please, you need to go beyond just sitting in this case.
Please share this current material you use for us. The one you share on the group is not that detailed.
No, I think I shared 3 materials.
Like what you used in the
I shared some other material with you already. I'm coming. Let me check. Oh, what up?
The one you share, sir, has only 4 points.
Don't worry. There is one with 8 pages, right? Have you?
You don't have the one for the 8 pages yet.
Yes, sir.
Yes.
You don't have the one for the 8 pages.
The pages in the group. It's in the group. The pages on.
Wait, which group are you that you don't have that one?
SBR 5.
I will check SBR 5 now. Let me even confirm.
You share with us only have 2 pages.
Who did you now offend? You are now omitted. Is there now? PKF.
2 pages now.
8 pages. Where do you see 4 pages?
Maybe you should just reshare it to the group just for her to get access to it.
Wait, I shared 3 things tonight. There's one that's just 2. There is one that is 8 pages. That's the PKF, and that's the one I used while I was explaining to you. And the question that I started. You guys should share with her now if you are in the same group. Okay, this is the.
I'm the one I did not download. I did not download it. I've seen it. I will go and download it now. Sorry, I'm sorry.
Okay, so I will try and share the other materials to you. I was trying to share it was not attaching, but I remember I was trying to share the whole thing. Maybe the network was not strong. So questions. Me, I want to go and people. Questions. So if there is none, no problem. We can then simply call it a day.
Hello, sir.
Yes.
Something is not quite long that I joined.
You said? You are not speaking up. Is it my own?
Can you hear me, sir?
Yes, I can hear you.
I say it's not quite long that I joined. Can you please run those 5 criteria, sir?
This 5 pass. Hold on, let me go and do this. I want to do.
Wow. Una mute na mic now.
Let me try and share what I'm sharing first. I will get back to you. So I've given you enough material now. All the best for you now. Take your time to reach. Okay, so the 5 conditions that must be met when it comes to recognition of revenue from contract from customer. 1, identify the contracts with customer. Determine whether there is a contract with customer. Determine the contract with customer. That's the first thing. 2, identify the performance obligation. Identify the performance obligation. Are you listening? Who was the person that said just join?
Yes, sir. We are
Yes,
listening.
I'm listening. I'm listening, sir.
Okay. So identify the performance obligations in the contract. 3, you determine the transaction price. Determination of the transaction price. 4, allocate the transaction price to the performance obligation. And lastly, if all of the 4 has been met, then recognize revenue. So the materials actually, there is one that is just 8 pages and it's in fact very concise and as well comprehensive as well. So that one would help to be able to understand how all of this, the further breakdown, the details that we have under them. So, and we have some other ones that are very voluminous that if you have the time, you can, even outside the exam, you can read it to understand what Ifrs 15 is all about. By God's grace, next week we'll be looking at Ifrs 16. This probably I think I've treated Ifrs 16 before, but no worry, I'll try and treat it again. So on these notes, I think we can call it a day.
Thank you,
Thank you,
sir.
sir. Good night.
You are the best.
Thank
You are
you,
the
sir.
best. You are the best. You are the best. We appreciate you.
Thank you, sir. Thanks for your time. God
We
bless you.
appreciate. I think we are not kids here. We should try to be off our